Have you ever wondered why history's biggest financial crashes seem to appear on a schedule? 1929, 2008, and now 2026 keeps coming up again and again. Now, I know, this sounds crazy, but the more you look, the harder it is to ignore. There's a rhythm, almost like the economy breathes in and out across generations. Every few decades, the same story repeats. Optimism, expansion, excess, and then collapse. It's not some conspiracy, it's a cycle. A cycle economists have actually tracked for over 200 years. It predicted the Great Depression, it predicted the global financial crisis, and right now, that same pattern is flashing red. Think of it like seasons. Spring, when economies recover and bloom. Summer, when optimism turns to overconfidence. Autumn, when debts pile up quietly. And winter, when the illusion finally breaks. Most people think we're still somewhere between autumn and recovery, but the data says otherwise. We're deep into winter, and this one's been delayed for far too long. If you've never heard of the Kondratiev Wave, don't worry. By the end of this episode, you'll see how this forgotten theory connects 1929, 2008, and the crisis that might define our decade. Because here's the thing. Cycles don't care about opinions or optimism or politics. They just complete themselves. And whether we're ready or not, the next turn is already in motion.
So, what exactly is this mysterious cycle that keeps showing up in the data? It's called the Kondratiev Wave, named after a Russian economist who, back in the 1920s, did something crazy simple. He looked at 200 years of economic data and realized it moved like a tide. Every 50 to 80 years, the global economy goes through a complete season of boom and bust. Not just recessions or market dips, civilizational waves that change how we produce, trade, and even think about money. Let's break it down, step by step. It moves through 4 distinct phases, just like the seasons of nature. Spring, the season of rebirth. After a crisis, everything starts fresh. New technologies, new optimism, new industries. Think post-World War II America. Factories retooled, soldiers home, everyone ready to build again. That was economic springtime. Clean air after a storm. Then comes summer, the boom. Confidence surges, wages rise, speculation begins. The 1960s were a perfect example. Endless growth, innovation, a sense that nothing could go wrong. But of course, that's when things always start to go wrong. Autumn arrives quietly. The system still looks golden on the surface. Stock market's high, wealth everywhere. But underneath, debts are piling up. Inflation sneaks in. Acid bubbles inflate. People mistake momentum for stability. It's like a tree in autumn, bright colors right before the leaves fall. And then comes winter, the cleansing season. Everything built on excess begins to crack. Companies fail, currencies wobble, governments intervene, and everyone asks the same question. How did no one see this coming? Now, here's the key. Each full cycle lasts about half a century. And if you trace it forward, spring after World War II, summer through the 60s, autumn across the 70s and 80s, and a delayed winter that should have hit in 2008, you start to see exactly where we are now. That winter wasn't canceled, it was postponed. And what happens when you try to postpone winter forever? You get a colder, harsher one later on. So the Kondratiev Wave isn't just a theory. It's a rhythm, the long breath of economies and empires alike. And the last breath we took is starting to run out. In the next chapter, we'll see how governments around the world tried to cheat the cycle in 2008 and why that decision might be the reason 2026 looks so dangerously familiar.
Now here's where things get interesting. Because by every historical measure, the economic winter should have arrived back in 2008. The system had already peaked. Debt was overflowing, speculation was everywhere, and the bubble finally burst. That should have been the natural reset, the cleansing phase of the cycle. But it didn't happen. At least, not completely. Instead of letting the system cool down, governments and central banks all over the world did something unprecedented. They froze the winter. Zero interest rates, trillions in money printing, corporate bailouts, emergency stimulus packages that never really ended. And for a while, it worked. The snow melted, the markets recovered, and everyone said, "Crisis averted." But it wasn't averted. It was delayed. That's the dangerous part of this story. Because when you interrupt a natural cycle, whether it's in nature, biology, or economics, you don't erase the pressure. You bottle it up. You push it forward. Think of it like trying to hold back a river by building a dam. The water doesn't disappear, it just waits, quietly, until the wall cracks. Since 2008, we've been living inside that artificial calm. 15 years of stimulus, of cheap money, of record debt. We built entire economies on the assumption that interest rates would stay near zero forever. But the world doesn't work that way. Even Rome, at the height of their power, tried the same trick. They debased their coins, adding copper to silver to keep trade flowing. It bought them time, but it also hollowed out their currency. When the reckoning came, it was brutal. Sound familiar? The 2008 crisis was supposed to be the end of a cycle. Instead, it became the beginning of the biggest monetary experiment in history. An experiment that stretched across a generation and distorted every signal economies rely on. We created markets that only understand one direction, up. We raised an entire generation of investors who've never seen true winter. And now, the temperature is finally dropping. The Kondratiev winter wasn't canceled. It's been waiting, patiently, for the debt, inflation, and demographics to line up again. And that's exactly what's happening right now. Because when multiple cycles, monetary, demographic, generational, all converge, the real storm begins. That's where we're heading next.
Up to this point, we've talked about one big cycle, the long wave, the economic seasons. But here's the twist most people never see. It's not just one cycle pointing toward this decade, it's several, stacked, aligned, all converging on the same narrow window of time. And that is where things stop being a theory and start feeling like a countdown. Let's break it down without overcomplicating it. You don't need a PhD in economics for this. You just need to see the pattern. There are three major cycles we're going to look at. First, the Kondratiev Wave, the long innovation and debt cycle of 50 to 80 years. Second, the debt supercycle, how long it takes a society to go from cautious borrowing to complete saturation. Third, the generational cycle, the rhythm of crisis and memory, the time it takes for a generation that lived through disaster to disappear. Each one moves on its own timeline, but right now, they're all landing in the same place. Start with the Kondratiev Wave, the last major winter phase aligned with the Great Depression in 1929. the sovereign crises and global conflict that followed. Roughly half a century later, we hit the conditions for another winter, around 2008. We delayed it with cheap money, but the math didn't vanish. Push that forward, and you land inside the 2020s as the pressure point of the next full reset. Now add the debt supercycle. Historically, it takes about 70 to 80 years for a financial system to go from debt is dangerous to debt is normal to debt is the only way this still works. The last peak of that leverage mindset was the 1930s to 40s. If you project that forward, the next critical peak appears right where we are now. This era of record government debt, corporate debt, and personal debt layered together. Two different lenses, same time window. Now we add the generational cycle. Every 80 to 90 years, roughly, a society enters what some historians call a fourth turning, a period where institutions are questioned, trust collapses, and a major crisis resets the rules of the game. The last big one? The period from the Great Depression through World War II. Move forward one human lifetime, and you arrive again in the early 21st century. Financial instability, political polarization, demographic strain. Different authors, different models, different data sets, all circling the same conclusion. We are living in the overlap zone. Think about what that means. The long technological and credit cycle is stretched. The debt supercycle is maxed out. The generational memory of true systemic crisis is gone. You have an economy addicted to cheap money, political systems under pressure, populations that have grown up believing everything always recovers, and a financial architecture built on assumptions that only work in peacetime. When one of these cycles turns, you get a recession. When two turn together, you get a deep crisis. When three line up, you get something that feels historical. This is why so many independent indicators keep pointing to the same narrow band. The first half of this decade as the stress point and the mid-2020s as the zone where pressure, debt, and demographics collide. Not because someone chose that year, not because of a headline, but because when you layer the cycles from 1929 to 1945 to 1970 to 2008 to today, the pattern is brutally consistent. We delay, we deny, we stretch the system beyond its natural limits. And then, suddenly it feels like everything breaks at once. So, when people ask, why are so many analysts worried about this decade? The answer isn't just inflation, or interest rates, or politics. It's that the long wave, the debt cycle, and the generational clock are all arriving at the same door. In the next chapter, we're not going to talk about theory and walk through the concrete signals flashing on today's dashboards, the yield curve, the debt levels, the cracks in real estate and liquidity. The pieces are already moving. The question isn't if the storm is forming, it's whether you recognize the clouds in time.
All right, we've talked about theories, cycles, and history. Now, let's talk about evidence. Because if the storm is truly coming, there should be ripples already visible on the surface. And there are. Plenty of them. Let's start with one of the oldest warning lights in finance, the yield curve. Think of it as the pulse of the economy. Under normal conditions, long-term interest rates are higher than short-term ones. That makes sense. If you lend money for 10 years, you expect a better return than for just 3 months. But when the yield curve inverts, when short-term rates jump higher than long-term ones, it's the market whispering, a recession is coming. That inversion already happened, and historically, every time it flips back to normal, a crisis follows within 6 to 18 months. Guess when that window lands? Between early 2025 and spring 2026.
Then there's commercial real estate, office towers, shopping centers, debt-heavy projects built during the era of free money. Over $1 trillion in refinancing is coming due between now and mid-2026. Higher rates mean those loans roll over at brutal costs. Vacancies are rising, valuations are falling, and banks are quietly hoping no one looks too closely at the numbers. Next signal, money velocity. That's the speed at which money actually moves through the economy. When people feel confident, velocity rises. Cash changes hands quickly. When fear creeps in, it slows down. Velocity peaked around 2022, and it's been sliding ever since. It's the heartbeat of growth, and it's losing rhythm. Now let's look at consumer debt. For a while, it didn't matter. Credit was cheap, wages were stable, everyone felt fine. But by mid-2024, something subtle happened. Household debt payments crossed 15% of disposable income. That number might not sound scary until you realize that every time we've crossed it before, a crisis followed within 12 to 18 months. People don't stop spending when they want to. They stop when they have to. Put these together. Yield curve on inverted in 2024, commercial real estate cliff in 2026, money velocity rolling over, consumer debt above the danger zone. Each on its own, manageable. All at once, that's the convergence. It's as if the economy is whispering the same year again and again. 2026.
If the signals are right, and if the cycles are real, then the next crisis doesn't arrive as a single explosion, it comes in phases. Slow at first, then all at once. Let's walk through them, because once you've seen this pattern, you'll start recognizing it long before the headlines catch up. It always starts with something small. A fund that blows up, a bank that fails, a sudden liquidity problem no one could have predicted. On paper, it's contained, a one-off, an outlier. Markets wobble, then stabilize. Commentators say, see, the system is strong. But beneath that, confidence has taken its first real hit. Investors quietly start pulling risk off the table. Credit tightens just a little. This is the hairline fracture in the ice. Most people keep skating. They don't hear the sound yet. Then the second phase begins. The same stress that broke one institution starts showing up somewhere else. Another bank, a real estate trust, a government bond auction that doesn't go as planned. Suddenly, it's not one bad apple, it's market conditions. It's systemic risk. Prices swing harder, spreads widen, cash becomes king again quietly before anyone says it out loud. People who weren't paying attention in phase 1 start to feel it in phase 2. Their portfolios, their loans, their job security. This is the moment when the shift from noise to narrative happens. And right on cue, phase 3, the rescue. We've seen this movie. Emergency meetings, press conferences, rate cuts, swap lines, liquidity facilities with acronyms no one can remember. The message is always the same. We will do whatever it takes. And for a while, the market believes them. Stocks bounce, credit calms down, everyone breathes. But here's the problem. Intervention doesn't erase bad debt, mispricing, or broken incentives. It just moves them. From failing firms to central banks, to governments, to the entire currency system. The fire doesn't vanish, it's simply pushed into the foundation. Then comes the part almost everyone underestimates, the secondary collapse. This is when the consequences of the rescue show up. The cheap money used to save the system, it fuels new distortions. The guarantees that no one will be allowed to fail,
they encourage even bigger risks. Inflation, currency stress, loss of trust in bonds once considered risk-free. At this point, the crisis is no longer just about markets, it's about confidence in the rules themselves. You see capital flight, you see people scrambling for hard assets, you see political pressure, social anger, narratives of betrayal. The first collapse hits balance sheets, the secondary collapse hits belief. And when belief goes, you're not just adjusting numbers, you're rewriting the system. And then, after the panic, the interventions, the disillusionment, comes phase 5, stabilization. Not a magical recovery, not a movie ending, a reset. Debts are written down, currencies are restructured, new regulations appear. A new generation of assets, institutions, and winners take shape. For those who only chased the boom, this feels like ruin. For those who understood the cycle, this is where opportunity lives. Every winter in economic history has eventually given birth to a new spring. New technologies, new systems of trade, new financial orders. But the transition is never painless. Winter always decides who learned and who just assumed summer would last forever. So when we talk about the coming crisis, we're not talking about a single red candle on a chart. We're talking about a sequence, a crack, contagion, intervention, secondary collapse, reset. Once you know the phases, you stop being shocked by the headlines and start reading them as coordinates. In the next chapter, we'll flip the perspective. Not fear, not panic, but how to think, position, and prepare so that when this cycle completes, you're not just surviving the winter, you're ready for the next spring.
So, what do you actually do with all this? Because hearing about cycles, collapses, and convergences is one thing. Living through them is another. Let's be clear from the start. This is not about panic, doom, or selling everything tomorrow morning. Winter is not the end of the world. Winter is the end of a phase. The people who get crushed in winter are usually the ones who spent the autumn assuming summer would last forever. You're here, so you're already doing the opposite. Step 1 is mindset. In every historical reset, empires, markets, currencies, there are always 3 types of people. Those who ignore the signals, those who react too late in fear, and those who prepare early, calmly, without drama, without noise. Your goal is simple. Don't be in the first 2 groups. Winter punishes leverage, complacency, and denial. It rewards patience, liquidity, and clarity. So the first move is not a trade. It's a mental shift. From how do I chase the last bit of this boom to how do I make sure I'm still standing when everyone else is forced to sell? Step 2, simplify your risks. Look at your life like a balance sheet. High-interest consumer debt, that's dead weight in a tightening cycle. Every previous crisis, whether 1929, 2008, or earlier panics, hit the overextended the hardest. Ask yourself, if cash flow tightens, what kills me first? Start there. Strength in winter is not about being flashy. It's about being hard to knock over. Step 3, respect cash and optionality. In the late stages of a cycle, everyone is trained to believe that cash is trash and you're losing if you're not fully invested. But if you study real crises, you'll find something interesting. The people with liquidity when assets are forced to reprice are the ones who can buy when everyone else is trapped. Cash isn't cowardice. In late autumn and early winter, cash is time and choice. You don't need to go 100% defensive, but ask yourself, if a real discount shows up, do I have the flexibility to act? Or am I locked inside the bubble I helped inflate? Step 4,
Think in resilient assets. Across history, when systems shake, real productive land, essential businesses, solid cash reserves, and assets tied to real demand tend to outlive the paper illusions. Not because they're magic, but because people still need food, energy, shelter, and trust, even in winter. Again, this is not a shopping list, not individual financial advice. It's a framework. Move a little closer to things that survive resets and a little further from things that only work in perfect weather. Step 5, prepare your psychology. This might be the most underrated part. When panic hits, valuations don't just fall, narratives collapse. You will hear, "This time it's over. Nothing will recover. Everything is broken." It happens every cycle. But if you understand the pattern, if you know that winter is violent but not eternal, you're less likely to sell at the bottom, less likely to freeze when opportunities finally appear. The advantage isn't secret information, it's emotional stamina. So what should you do? Get lighter where you're fragile. Get stronger where you're exposed. Hold some liquidity. Stop worshiping endless expansion. And train your mind now so you're not making your biggest decisions in maximum fear. The cycles don't ask for your permission, but they do give you warnings. Most people ignore them. You don't have to. In the final chapter, we'll tie it all together. Because when the next headlines say, "No one could have seen this coming," you'll know that's not true. You saw the pattern. The only question is what you chose to do with it. So, here we are. We've walked through the long waves. We've seen how 1929, 2008, and today fit into the same rhythm. We've watched the indicators light up. We've mapped the 5 phases of collapse. We've talked about how to think, how to stand, how not to break. Now comes the part everyone gets wrong. Because when a major crisis finally hits, the first reaction is always the same. Nobody saw this coming. But that's never true. The signs were there. They're always there. The real problem isn't that no one saw it. It's that no one wanted to believe it. If you're listening to this, you're already miles ahead of most people. You understand that markets move in cycles, that debt has limits, that generations forget, that every endless boom in history terminó igual con un ajuste, con un invierno, con un cambio de reglas. And that doesn't make you a pessimist. It makes you a realist. Because recognizing winter is not about cheering for collapse. It's about refusing to be blind inside of it. Think of every empire, every system, every golden age we've studied. None of them thought they were temporary. None of them believed they were the bubble. Yet the pattern repeated. Overstretched credit, political stress, currency tension, social fatigue, and then a reset that looked sudden only to anyone who hadn't been paying attention. You don't control the cycle. You do control your preparation, your leverage, your patience, your curiosity. That's your edge. So when the next headlines appear, the bailout, the bank run, the unthinkable event, you'll remember this. It's not random. It's not new. It's the final turn of a pattern that's been building for years. Most will panic, some will freeze. A few will recognize, this is the winter we talked about. And on the other side of winter, for those who kept their head clear, their risks measured, and their options open, there is always a new spring. If this helped you see the pattern a little clearer, stay with us, because this channel exists for one reason: to make sure you're not the last to know when history repeats
in real time.